And hello, Propenomix people, and welcome to another Sunday Supplement Live. This week's I called Good Regulations. Supposed to be a little play on words of Good Vibrations by the Beach Boys. Not sure that one worked out so well, but never mind. Can't get it right every week, can you? So if you've listened before, you'll know I like to start with a quote. And this week's was, I was an advocate of the deregulation movement, and I made, along with a lot of other smart people, a fundamental mistake. The financial industry undergirded the entire economy, and if it's made riskier by deregulation and collapses in widespread bankruptcies, as what happened in 2008, the entire economy freezes because it runs on credit. And that was from Bill O'Reilly, the political commentator. And the reason for using that quote this week is that's all about the subject matter of this week's deep dive. Does this look like a run-up to another 2008? Well, you'll find out later. But before I go in full hammer, Rod Turner and I will be running our next property business workshop on Wednesday, the 1st of October in London. Feels like a long way away. It always does in July, but it's less than 2.5 months away now. And the subject matter this time is investment, with an emphasis on what metrics you really need to be considering to run your property business properly and building your business to scale. We're digging into the real fundamentals of property investment for growth, from proper valuation and strategic debt structuring to the investment metrics serious pros use. Hint, ditch ROI and yield. Learn why some deals work for some and not others, how to manage risk as your portfolio scales, and when to shift gear from side hustle to scalable business. We'll break bottlenecks, build strategic pillars, and unpack real-life case studies of fast company growth. How have we done so many deals? Well, we'll tell you. Book the super early bird tickets with 20% plus off the face price now at bit.ly/PBWEIGHT, and there's a link in the show notes to those tickets. Anyway, I'll press onwards into Trumpwatch. I performed a social experiment by accident in this past week when I posted about the 50 billion take on tariffs for June in the US, and I dared to express an opinion about Mr. Trump. The lovers and the haters descended on me at scale. 396 comments on the LinkedIn post and counting at this point. It's fair to say that not many of them were overly keen on a fact-based conversation, and not a single one had a rebuttal when, after basically being told to shut up and that I wasn't allowed an opinion, I cited their internationally famous position around free speech. First Amendment, right? Apparently that only works until you're saying something they don't like. Who knew? Onto the tariffs anyway. The estimates are now around 20% as the average tariff rate. Looks an awful lot like VAT in the UK, doesn't it? Assuming August the 1st goes ahead as planned. Mexico and the EU will be faced with 30% on goods, as stated by Mr. Trump in the past week. Inflation also jumped this week back to 2.7 in the US, with consumer goods being affected. We're talking a couple of percent short and long term on the price of goods because of this. There's a direct cost or loss per household estimated at about $2,800 per household in 2025. Although if my LinkedIn post is anything to go by, some are still swallowing the story that the country of origin is paying the tariffs rather than the US consumer. 3% inflation is back on the table as a sensible prediction by the end of 2025 now in the US, thanks to the tariffs. Clothes and shoes are hit particularly hard because of their country of origin, with shoes and clothes forecast to go up 40% plus in the short run because of the tariffs. Yale have done a study and they see a drag of 0.9% in 2025 on GDP. We know Q1 in the US was disappointing, although it was also distorted by a mass amount of imports. They also see unemployment up by 0.5%, and these are always hard claims to verify because how do you know what would have happened versus what ended up happening? You can look at 2025 forecasts versus outturns, of course, for both GDP and for unemployment. But then for someone who spends so much time telling you that forecasters don't get it right, that's a difficult one to defend to an extent, isn't it? But I don't know what else you can do because you can't rewind the clock and play the world out in a different way, of course. But one of the most important conclusions from the work that Yale have done on the tariff is that the manufacturing sector does expand, but there's a cost to construction and to agriculture, which is larger. And so GDP actually shrinks overall in the long run. However, there is that inconvenient truth that the tariffs would raise around $3 billion over the next 10 years if they stay in place, with only $500 billion in negative revenue effects. Make no mistake, this is a transfer from the households to the government, nothing more, nothing less. The context, well, the US is burning $2 trillion more than it is bringing in each year, and this is a $250 billion contribution, roughly, towards that $2 trillion. Or you could say it solves 1/8 of the problem at the moment. And that's all great stuff, and that would assume there were no negative impacts, which of course there are in terms of GDP drag and all the rest of it. But well done to Yale for producing a comprehensive report. It's hard to do when the wind changes as often as it does in the Trump world, and there will be more changes. But what's clever is this federal VAT has effectively been introduced with a good slice of the country still falling for the misdirection that's been pumped out around all of this. The dream of reshoring needs stable policy to take place. And maybe that's the plan after August the 1st. You'll be kidding yourself if you think countries won't relocate to the US, companies won't put their factories there or whatever, but they're also going to need some incredible subsidies to do so, because there's going to be a concern that once the 4 years are up, or 3.5 years as they are now, these situations will potentially be reversed. Very rarely would you reshore an operation and then have your money back and a significant return on that investment within 3.5 years. At least half that remaining time frame is going to be spent finding ideal premises, getting through planning and zoning, etc., etc. It's one of the more fascinating economic real-time case studies of modern times. That much is for sure. For once, the bonus is that the UK is largely unaffected. And from a comparative advantage perspective, which is important in international trade, we may well actually end up benefiting from the situation. It's probably point 2 when I've been grateful to be outside of the EU. The first one being the early days of the distribution of the COVID vaccine, but probably the first time I've actually been economically grateful. Now, the one big, beautiful bill on latest figures will need 3.4 trillion more debt issuance over the coming years to 2034. More tariffs, pressing for rate cuts, inflation, although according to some of my Illuminati from my LinkedIn post this week, the trade-off between inflation and interest rates doesn't work like that. And then also stablecoins are somehow going to sort all this out. I think stablecoins is really interesting as an aside, because probable stablecoins will not be pegged solely to the US dollar. There's a high chance there may be a basket of currencies that a stablecoin is pegged to that keeps everybody more happy. And that's just one further step in the erosion of the dollar as the world's reserve currency, which then means, apart from anything else, the US just simply cannot run the sort of deficits that it has been running. They're already unsustainable. If they lose any more reserve currency status, and contrary to popular demand, it's not like a switch that goes overnight and you go, oh, now we're the world's US reserve currency. Now we're not. It's nothing like that. It's a slow ebbing of power, which may have some seismic events in it, such as Bretton Woods did, such as bringing back the gold standard after the Second World War did. Yes, there are moments in history that are big and important, but it's a slow, painful maneuver around all of the rest of that, especially if the US will be keen. Will Trump want to be the man who broke the dollar as the world's reserve currency? Doesn't sound like the sort of legacy he would want to leave, but we'll see. Ultimately, Erdogan tried this in Turkey. He put rates down and inflation went up and up and up, and it got to about 60, 80%. And he had to then concede and put the rates up in the end anyway. And it was much worse than it would have been if they just let the central bank do their job in the first place. And that's a very recent thing that happened. Yeah, Turkey's not the US, sure thing, yeah. But the economic theory works in either country. My concerns are still also centered around Jay Powell's replacement next year as Fed chair. They're starting to talk about who it will be now. And really the only alternative for that Fed chair will be effectively yield curve control, effectively something like the Japanese central bank have been doing. Lots more buying of dollars, of bonds by the Federal Reserve. That's ultimately the only way out of this situation for the US, apart from defaulting on their debt, which is never going to be an option unless there was a very strange vote around the debt ceiling at some point, which I suppose is also a possibility, but much less likely. Now, I don't think there's much chance of Jay Powell getting fired. People are putting forward the fact that he may resign in order to preserve his reputation, but a resigned central banker leaving a ship that may well then sink doesn't seem to be much of reputation preservation to me. If he did do that, I think the bond vigilantes would have a field day. But then again, you can never really guarantee what Mr. Trump is or isn't going to do. So on the current forecasts, you've got debt to GDP up to 130% by 2034 in the US. It's not a nice position. Throw one shock in there and you've got problems. This would see 20% of the federal budget spent on interest payments. 20%. Unthinkable, really. But remember, when the US sneezes, the world catches a cold, and our bond yields in the UK are more inextricably linked to the US yields than any other significant nation. But I'm going to continue keeping my eyes open, and I'll pop the occasional post on the socials about the issues too. But back to our main subject matter, the real-time UK property market. Chris Watkins took a week off. Well, everyone's entitled to one, right? But he still delivered some analysis of interest before he downed tools. His subject matter this week was house prices and the regional effects. A whistle-stop reminder, the history book peak was October 2007 in house prices. Then the credit crunch came. Values then dropped significantly over the next 18 months to March 2009. 18.5% was the official print for the nation, with most areas being contained within the -17 to -19 nominal price bracket. But then it was the recovery that took very varying degrees of time when you slice it regionally. London as a region hit a new high in April 2012, nominally. Some parts of the country took well over a decade, as you may well know. In inner London, that date was April 2011, as the rebound was real. In the City of London, that rebound date was actually February 2010. So Chris describes it as a realignment of economic gravity. Lovely use of words there. In reality, foreign unleveraged money poured into London, £100 billion plus over the course of a few years, buying cheaper assets in the wake of the crash in a country with a stable political regime, useful rule of law, and a solid land registry, apart from anything else. But Chris's main point here is not all crashes are created equal. Now, I always give Chris a weekly shout out here because he's more prolific than just this epic tome he releases weekly on the UK property market. He comes up with some great stats on a regular basis. If you drop him a like, a subscribe, a follow, and all the rest of it, and some kind words for his content creation. And if you're in the industry and you want support in growing your business or to be a more effective communicator, be more in touch with your local market, that's his core business. So give him a shout. His article gets published on the Property Industry Eye website and the video on his YouTube channel at Christopher Watkin. Okay, here comes this week's Macroeconomic, which might steer you as to how bullish or not this section might be this week. It's meat week as well. No room for the vegans, I'm afraid. Inflation, bang. Unemployment, bang. If that's not enough, the ONS-PIPR, the price index of private rents and house prices from the same source. We will mop up with the gilts and swaps. Always watch when they don't move as you'd expect. So inflation, it's been my focus here for just over 4.5 years now. It was coming, it's still coming, it came, it isn't going away. That sort of covers the 4 positions I've had over that time period. And each one has, I'm sorry to tell you, been correct. And indeed, at some points, although I was screaming fire, I wasn't telling you to get a big enough hose. I'll mention once more my insistence on sharing my own break and fix now plays in 2022, which indirectly led me to be invited on a great day out this week. So thanks to my number one fan. I do appreciate you. You know who you are. But so far, all of the forecasts that I've made, and of course not all of them have been correct. Inflation has been the one I've been one step ahead all the way in this cycle. Tariffs have had me a little off balance. Whilst it's clear they would have the sort of impact they're having in the US, pumping it upwards, it isn't so clear around the second-order consequences for the likes of us. Indeed, as discussed earlier, the UK is in a rather unique position of not having anywhere near as much of the wrath of Mr. Trump to deal with as other blocs or nations. Still, they're by no means the only fruit. I discussed the over-drop-off as inflation fell dramatically when energy prices normalised, or more accurately, the energy component went negative for some time. But that was all normalised by about Q3 last year, really, in 2024. But that left a poison pill for September 2025 because the nadir was in September 2024. And so the base effect is that inflation will look worse in that month than any other, all else being equal. What we don't need in September 2025, I can tell you, is a sudden strengthening of the dollar or another rumble in the Middle East leading to a surge in oil prices, because the stage is already set for a bad print. Why is September so important anyway? Well, because the CPI print that month is used for index-linked benefits, including pensions. A small amount of rounding could be an extra billion these days. We don't have any extra billions at the moment. So the backdrop was already bad, and then national insurance changes and well above market minimum wage rises pushed up prices in various sectors anyway, as businesses simply passed on whatever their respective markets would allow. Council tax was up circa 5% to boot, And water was up 26%. That was Ofwat's figure. April was, as named, awful. The effects are sticking in the calculations for 12 months, of course, because that's how the annual calculations work. On to the reality of the report for June then, which was released this week. CPIH, that includes housing, the ONS preferred metric of inflation, is back above 4%. That's really ugly. And it's not a good job that not too many places take much note of CPIH. 3% is bearable. 3.5% is twitchy time. 4% is really DEFCON 2, because the slightest slip takes us into difficult to control territory. CPIH includes those housing costs and has been printing above CPI for a couple of years, as household cost inflation has been exceeding the other items in the basket of goods by some amount. Why? Mortgage rate increases and rent increases, simply put. The economists all thought 3.4% on average for CPI, as in the same as May's print, but the actual print was 3.6. CPIH was 4.1, up from 4.0 in May. The annualized rate of inflation based on the last 6 months will actually be 4.7 for CPI, but April's 1.2% rise in 1 month has been deemed a one-off, although the last 4 Aprils have been 0.3, 1.2, 2.5 and 0.6. Okay, you could probably write off or write down 2023 and 2022, but still 1.2 isn't far out of keeping even with the lower ones. As usual, though, it's being played down, but that's for good reason, really. Nothing worries bond markets more than on a continual basis than inflation. CPI and core CPI are still very close to each other, and that convergence hasn't been that common over the past years. But core CPI measured 3.7 and core CPIH measured 4.3. Neither of those suggest a return to 2%, as early has been suggested by the Bank of England, who were at the beginning of this year saying we would go into 2026 and see 3% inflation in Q1 26, or whereas the wider economic community was suggesting more like 2.5 or under. Once again, I was out on my own, stuck at predicting 3.5% plus at that point in time, but still that seemed relatively obvious to me, given that the national insurance rises had already been announced, apart from anything else. There's plenty of time before Q1 2026. I'm not right yet, apart from anything else, but there's limited disinflationary factors to come into play, you would think. Stronger for longer, I've said for years. What's the one thing that could make that wrong? A continued downturn more aggressively in the fortunes of the economy. It's not immediately obvious that unemployment, which we'll discuss in a bit, is actually worse for the economy at the sort of level it's at today, rather than employing people in unproductive jobs. But there's an argument either way. Difficult to measure, to be honest, apart from anything else. The one happy part, OOH, the owner-occupier measure for housing, that's the H in CPIH, really, is still falling month on month. But the bad part, well, it's still printed 6.4% in June. It was 8% at the turn of the year, and there's now evidentially very much on its way down at a pretty good pace. The gap between that and CPI is now as narrow as it has been for over a year. Rent rises the way they were simply weren't sustainable. The CPI print was the highest in 18 months, and that figure in January 2024 was a print on the way down to that magical, or stay of execution, as I described earlier, print of 1.7% in September 2024, which seems like a long time ago now. We're more than double that at the moment. Components then of note of inflation. Food looks ugly for those on lower incomes particularly, printing 4.5% year on year, likely still being concentrated in lower price foods as well, as it's still the cost of delivery that is rising faster thanks to wages and the likes. Education inflation remains high and will be for another year at least, as September fees for the private schools, lucky or wily enough to remain open, are also up above inflation at most places due to business rates and above market pay rises for teachers and pension costs spiralling as well. Services inflation eased slightly, but still sits at 4.7 for CPI services and 5.2 for CPIH services. Still ugly stuff, folks. I've talked about 5% being problematic, and here we are halfway through 2025, and we're still at that sort of 5% level. 2% is a healthy year or more away at this time in terms of services inflation, and that's before the coming budget, which seems unlikely to contain anything particularly disinflationary, shall I say. Even goods inflation, which was down to zero and even negative for a while, has reared its head back above 2%, printing 2.4 this month. That's the highest print for goods inflation since October 2023. Our 3.6 compares unfavourably to France's 0.8 and Germany's efficient 2.0. What did the ONS pick out in their report? A large change, 0.1% actually, caused by motor fuels not going down as much in June 2025 compared to a year ago as they did in May 2025 compared to a year ago. Not really a point worth making, let alone including in their summary, but mathematically, I suppose they had to because they were following instructions. There we go. Down or up from here? Well, September still looks risky. Gun to my head, we're still going up again from here before we start to make a descent. Will we hit 4% this year? It might be touch and go. 3.8% looks nailed on before we get to 2026. Translating all of that into gilts and swaps, all else equal, inflation surprisingly high print equals slower rate cuts than thought before. Slower even than August's likely cuts. Well, probabilities for that are swinging between 80 and 90% as happening. We'll see. That one's likely a decision that's already been made, although job data is always important. So, on we go. Unemployment, my second specialist subject of this cycle. I'd called 4.8% this year, early on, when the Bank of England was suspecting we'd stay closer to 4.5. By their own admission, their unemployment forecasts are poor, but they're normally too bearish. This time around, they've been too bullish, or they expected the April national insurance changes, amidst everything else anti-growth that's been going on, to take longer to kick in than they really would. The expectation from the economists, the consensus, was a hold at 4.6, but instead we printed 4.7. It's another miserable one, folks, I'm afraid. The usually overbearing estimated payrolled employees for June 2025 was down 41,000 on the month. This is normally revised upwards, but raises no smiles. Payroll employees have been hemorrhaged over the March to May 3-month period. We've lost 68,000 of them, according to the ONS Labour Force Survey estimates. Pay growth moderated to 5%, down from 5.4 the month before. Now, this was always on the cards, and actually will keep the Bank of England economists happy, because we're on a downward trend now, back to a more sustainable, around inflation world. They do need to come down to contribute towards a sustainable and slow disinflation, so it isn't terrible news, but the fairly sharp reduction probably also gives you a little bit of real-time insight on the jobs market at the moment. And any sort of introduction, suggestion of volatility never keeps economists, central bank economists certainly, particularly happy. They prefer slow-moving paths because that implies predictability, lower volatility, better for investment. That's ultimately their job. So thanks to the inflation situation, those numbers are only now 1% above CPIH in real terms, or 1.7% above CPI. CPIH is much more realistic, which is why the ONS prefers it. Now, this earnings growth splits down to 5.5% for the public sector and 4.9% for the private sector, which seems to be starting to grate on the public from what I'm hearing, and the lack of public support for the mooted resident doctors' strike, apart from anything else. The industries with the most minimum wage workers per head are still showing the strongest annual growth rate, which is pretty much guaranteed when you have 6.7% minimum wage growth and above. The wage growth in those sectors is 7.1 year on year. That's also forced forward by a higher minimum wage growth for 16 to 17-year-olds and 18 to 20. On to my favoured breakdown of the market. 75.2% employed, 4.7% unemployed, and the inactivity rate down to 21%. The rounding error occurs because not all of those groups are restricted to 16 to 64s, which makes no sense anyway as a bracket, considering you work till 67 now, and that hasn't done for years, but it's just one more overhaul that's needed at the ONS in one of their very most important statistics as well from a governmental macroeconomic investment perspective. But hey, you know, why change it? They're not even talking about changing that yet, which is crazy in my opinion. Nobody seems to sense check these statistics for their actual usage and actual validity as well. Vacancies plummeted once more, down 56,000 in this quarter, and now coming in at 727,000 in quarter 2 of 2025. And that's now a solid reduction quarter on quarter for 3 years running. We also lost 37,000 days of work thanks to labour disputes. Eye-poppingly, that's actually a relatively small number, but of course there's rumblings of more, some with higher profiles than others. there are now 68,000 fewer job vacancies and plenty more people, remember, than the quarter just before COVID. Now, 75.2% employed is still unfavourable compared to December 19 to Feb 20. In that quarter, before we saw any real pandemic disturbance at all, 76.4% of people were working. Similarly, the unemployment rate at that point was 4% rather than 4.7. The inactivity rate at that point was 20.3. So of the employment we've lost in percentage terms since COVID, about half are unemployed seeking work and the other half are not seeking work, studying or long-term sick. Remember, that's not the same people, but for a visual perspective, that's really what it means. It's miserable. This is Labour's trademark, or one of them, increased unemployment. Their delayed, watered down, but still coming labour market reforms will do even less to create jobs. Hoist on Rachel Reeves' own petard of extra regulation, employers will seek to offshore more and look at self-employment options also. The redundancy rate currently is 3.9 jobs per 1,000 in the most recent quarter, compared to 3.4 jobs per 1,000 12 months ago. It's all going the wrong way, but fairly slowly. That's about the right summary. I don't remember the last time I heard any kind of speech, let alone an inspiring one, about job creation. I wonder if all they get back is abuse from the myriad of businesses struggling under the weight of the extra taxation at all levels, and so they've just given up. Now, I dare say they will wait for the conference, and that's only late September, by which time inaction will be the watchword once more anyway in the real world, waiting for the budget or the sword of Damocles once more. This unexpected unemployment should make bond yields fall, as the expectation, all else being equal, that rates would be cut sooner to avoid unemployment becoming a problem. But the thing is, 4.7 isn't really considered problematic, so that effect is dulled anyway. And it's in direct contravention with what you'd expect from the inflation figures, and the inflation figures were a bigger miss to the upside than the employment figures were to the upside. But that doesn't correlate directly, but it does have an impact. Now, both of those are very important in rate setting, but inflation is the single most important for good reason. Okay, will private rents and house prices cheer us up at all? It was the ONS's turn to release their monthly effort, which covers rents for June and house prices for May, which is always an opportunity for extra confusion. But the annual increase rate is 6.7% for rents, very close to that OOH level in the report, in the inflation report, as usual, and that's down from 7% for May. Scotland is still printing much lower after the lifting of rent controls. Go figure, eh? It wasn't like there was a huge body of evidence pointing almost exclusively one way, a bit like the evidence on wealth taxes, but that's another question. Scotland is up 4.4, Wales 8.2, England 6.7. Northern Ireland's data is a couple of months older, but printed 7.6 as their buoyancy continues. Then the ONS has the annual house price increase at 3.9 for May, up from April's 3.6. And we saw some anomalies around that index, around the stamp duty cliff, which plays out, and that will have an effect next year on the figures as well, because of those base effects I talked about and inflation earlier on. But on the downside next year, around February and March, because those prints in Feb and March were too high, realistically, for this year. Now, the primary conclusion is that in most areas, yields are still increasing to compensate for lower or no cash flow, thanks to interest rate normalisation. This has been the story for the thick end of 2.5 years now, according to the stats. House prices started increasing faster than rents in August 2020, and then drastically outpaced rents until January 2023, where that trend was reversed, and in a similarly dramatic fashion, with house prices actually nominally falling, according to the ONS, between July 23 and March 24. Rent inflation instead has had a double peak, because it hit 9% in March 2024, dropped back a little bit, but then hit that 9 again in November and December 24. So that 6.7 for June looks a lot milder in that context, and the pace at which rent growth is outpacing house price growth is starting to converge again. So in other words, yields are just about still on the way upwards, but it looks like maybe in about 6 months' time or so, those two lines will cross. House price inflation was 3.4 in May 2025. That was in England. Right, the national figure in Wales was 5.1, Scotland 6.4, and Northern Ireland 9.5, still rocking and rolling. And the ones moving above that 3.4 figure in regional terms, the North and the Midlands, very much the pattern as interest rates started to normalise. The south has felt it a lot harder. So we're below that average in the south still. But for the first time in many months, the northwest was slightly under the average, printing 3.3 for the year. The northeast remained at 6.3, with both Yorkshire and the Midlands, at the East Midlands, at or just over 5% house price growth. It remains a tale of two halves, but with the southern regions all printing very close to 2%, the normalisation process seems to have now stabilised, but it's leading to a slow creep in affordability when it comes to wage rises kicking in. On regional rents, London at 7.3 slipped to fourth place in the table, behind the North East at 9.7, the North West at 7.9, and the East of England at the same figure. The regional pattern isn't as clear as it is with house prices. Midlands are sort of flanking the average, and then the South West is at 4.8, but Yorkshire and the Humber is at 3.5. It just seems to suggest to me that perhaps if there's one area of the country with plenty of rental stock that's around, it must be Yorkshire and the Humber. But you can look at rents by size or by the number of bedrooms. The interactive maps are fantastic. You can go and check it out in my supplement published on my LinkedIn page. Please go and give me a follow and a comment and a like and all the rest of it if you're not already following my LinkedIn newsletter. Anyway, so house price growth is continuing at pretty much inflation, according to the ONS, with rent growth still a few percent above that. The sooner it's down to earth, the better for the sustainability of rentals for tenants. The market is functioning to bring more landlords by tempting them with juicier percentage returns. This is Adam Smith's invisible hand at work. Well, that's one way of looking at it anyway. Anyway, that leads us to the gilts and swaps as always. The gut feel would have been a yield expansion week based on our macro, and indeed it was. The Wednesday inflation report moved the yields about 5 basis points, and the jobs report did no real work to moderate that, to be honest. There was another move on Tuesday there around 2 p.m, which was of similar magnitude to our inflation news. And that sort of timing in the day means it's come from the US. And it was their inflation print. The inflation print in the US moved them from 2.4 to 2.7, as discussed, much to do with the tariffs. It wasn't a surprise to their economic consensus, but still the confirmation hardened those UK yields as those two track each other quite so closely, with, of course, the UK deemed to be the follower of the pair. So we opened the week on the 5-year gilt at 4.061% yield and closed it at 4.095. You can't have that down as a disaster. 3 and a bit basis points the wrong way. But the trend had been downwards before those inflation numbers. So the US numbers and then our numbers ultimately raised things quite significantly from the downward trend we'd started on Monday morning. Thursday's close was 4.091. And the swap market closed at 3.725 on the 5-year. So we're still at that 36, 37 basis point level for the discount. That compares to 3.674 1 month ago and 3.809 1 year ago, retaining that convergence that has appeared in the past 12 to 18 months. How about the longs? Well, I've seen a particular ramp this week in multiple places for buying the long-dated bonds in the UK. Not that I think it's the worst idea in the world, but it's been across a number of publications, whether it's asked as a favour by the government, the Treasury, the Debt Management Office, I don't know. But there are also noises suggesting that the DMO, the Debt Management Office, might stop issuing longer dated bonds. Now, this makes far too much sense to be normal policy. The point is that the cost of them to the Treasury is much higher than the shorter dated debt. But of course, if you stop issuing them altogether, well, you're showing a real lack of confidence in the long-term future of your economy. And in itself, that would cause further problems. But you could certainly cut down the amount of them you were throwing out into the ether at the moment. The 30 years followed a very similar pattern to the 5 years, but opened at 5.45 yield and closed at 5.51%. So it's a 6-point difference for the 30s versus a 3-point difference for the 5s. That steepens the yield curve just that little bit more. Yes, it's a subtle difference, but it's one I'll be keeping an eye on for the foreseeable future. Why would so many outlets be pushing 30-year bonds as a great bet, even if they were doing it without any other agenda? Well, even if they don't realise it, they're advocating for inflation not to be the long-dated problem that the likes of myself have said it will be after a pandemic. But there are other reasons as well to make that bet or take that position. As and when a recession comes, a couple of which are highly likely in the next 30 years, if not 3, Yields are likely to fall across the board. If you took a position that the next recession or crisis event will happen to be a particularly bad one, then buying 30s at over 5.5% yield actually makes a lot of sense. My biggest fear around all of this, I'm seeing buying the 30s as more of a hedge against a particularly bad recession or crisis event rather than a bet on inflation being brought under control. But of course, if the economy gets flatlined, inflation, the stuffing will be knocked out of inflation, although it doesn't necessarily happen at the very beginning of a recession, is that if any long-term investors can buy and do nothing at 5.5% return a year, how does that impact long-term projects with similar time horizons in the UK? The recent report that I covered, Making Affordable Homes Viable 6 weeks ago, mentioned an IRR of 5.5% for not-for-profits being acceptable. Well, 0.01% under the 30-year gilt yield, that IRR of 5.5 goes up, not down, increasing the cost of building social homes. And you might think 5.5 to 5.75 or 5.5 to 6 doesn't make a big difference. But believe me, it does, especially when you're talking about hundreds of billions of pounds. So it's got to go down as one more week with a yet steeper yield curve, and my eyes will stay on it, and so will my reporting. But that leads us nicely to the deep dive. You won't have missed the fact that the Chancellor gave a speech in the past week, I'm sure, the Mansion House speech, and this was her second such speech, a second Mansion House. The first one was a couple of weeks after her dreadful 2024 budget. Reeves used it as a platform to reaffirm how much she wants the job and calm any doubts about her cracking up or getting fired, neither of which she's really in control of course. I do believe, though, for what it's worth, that she always did want this job, and in spite of how hard it is, or perhaps even because of how hard it is, she won't be doing the former, and I'm much less convinced of the latter than many of the political commentators are as well. She chose to focus on what has arguably been achieved, or at least points that she promised and can politically claim to have delivered. Restoring stability. Well, you can't argue with the mess created by changing leaders so many times in the past administration, for example. Just turning up and sticking around has ticked that box. Securing investment. Well, I'm more sceptical, but they're claiming over £100 billion of investment secured since they took office from international sources. I think some was soft pledges turned into harder agreements, but either way, they've pledged more than they've raised and more than they will raise from the taxpayer, which means it's primarily debt funded with private sector or international investment coming in second. She then stuck with delivering reform, the one phrase they really, really need to reword if they have an ounce of political nous, because the word reform only means one thing these days. And frankly, nothing about small r reform has been delivered yet other than some changes to the planning system. There's lots of it being talked about and some encouraging noises, but we need demonstrable evidence of things done rather than plans that are a percentage of the way through and the mostly poorly communicated. Reeves then talked about renewal, the renewal of Britain in every home and every street, but then chose to focus on the financial services sector. 10% of GDP and 1.2 million jobs she cited, so far fewer jobs than its GDP contribution percentage, which won't surprise anyone. You know, about 1 to 3, the ratio between the GDP share and the job share, ultimately, when you look at percentages. Now, the next part is hard to disagree with. There's nothing progressive about a government that simply spends more and more each year on debt interest instead of the priorities of ordinary working people. The unfortunate part here is that exactly what she's going to preside over for the remainder of this government if she is staying. So what? Well, she simply restated her commitment to the fiscal rules. She then claims the 4 cuts in the base rate since the election, reducing the cost of mortgages and business lending. We know this effect in reality has been very small. Just looking at the 5-year swap market compared to 1 year ago, there's no real discernible difference. And there's certainly not 1% worth as there is in the change in the base rate. So this is inherently a disingenuous statement. But anyway, there'd also been some fortuitous timing for a financial services speech, with the FTSE breaking 9,000 for the first time on the day of her speech. The FTSE that's coping with a dramatic lack of IPOs and continuing disgust at the stamp duty on shares. The FTSE that will now start to list shares in dollars and euros, if that's supposed to be a step forward. Private company share trading is also coming on Pisces, as she referred to in her last Mansion House speech back in November. That's now coming this year, apparently. And yet one more quango, the listings task force to get more companies to list in London. I think they'll come up against the same blockers, the very blockers that Reeves asked for a list of and promised to do something about. But perhaps stamp duty on shares will be abolished after all. The city can hope. Pension fund mega funds will, it's claimed, start to put something together that looks more like a Dutch or Canadian pension fund system, meaning they can make larger and more meaningful investments, and also meaning that running costs are lower, and so the pension fund beneficiaries can keep more of their hard-earned proceeds. It's hard to be overly negative about that. It's more a case of get on with it. As we get more into the meat of the speech, the Chancellor refers to her Leeds reforms, the most wide-ranging package of reforms to financial services regulation in more than a decade. And this is accurate, partially on the basis that not much has happened in financial services regulation in the time after that, after the stabilising of the mortgage market, thanks to the mortgage market review back in 2012. You could, of course, point to things like, Basel regulations and things like that. But ultimately, they are not really first-order consequences on the consumer, on the customer, whereas these are. These reforms are pretty comprehensive, though, and they are worth a detailed look. So what's actually being done in terms of cutting regulations then? Well, a streamlining of the SMCR, that's the Senior Managers Certification Regime, simplifying accountability requirements for banking executives. Smaller banks are benefiting from easing capital requirements to boost their ability to write mortgages and to lend. The Ombudsman Service is also being reformed, including a lower rate of interest for compensation claims, which was singled out in the press as one that was selling customers down the river, according to Martin Lewis. Ring fencing rules are being reviewed, not to damage the protective structure, but to explore resource sharing, read cut costs. The looser income thresholds you already know about from the past few weeks here have suggested that 36,000 first-time buyers annually will be helped. Although when I went through the figures last week, I suggested it could be closer to 100,000 in year one, as discussed, extrapolated from the Halifax Price Index. Consistent rent payments can now count towards affordability assessments, which is great and has been called for a long time. The government-backed mortgage guarantee scheme can let lenders take more risk and therefore also get the benefit of better returns. Then there's the much-discussed retail investment matter, encouraging the person on the street to invest in stocks and shares. Just as the 30-year bond reaches a very tempting 5.5%, as discussed, timing is everything, and this timing is poor. Reminiscent of Skipton releasing the 100% mortgage when rates have gone from under 2% to over 4% and at points over 5% post-Truss. The question is, will the phrase "the value of your investment can go down as well as up" be changed? There seems to be a big dilemma here, but here's what I'd do. I'd get the most influential financial commentator, probably Martin Lewis, perhaps Robert Peston as well, as he's very well trusted, and I'd also get some less advanced in years to communicate more effectively with the younger generations. For example, the two guys from the Making Money podcast, Damien Jordan and Timian Accarelli, and Kia Commodore and Emily Nutley, to get a blend of approaches and get them to record and explain a video which explained the following: the returns of the stock market on average over the past 100 plus years, the variance, how much markets can go up and down by, the time horizon that should be being considered, 5 years as a minimum, likely 10 plus years, what pound cost averaging is and how it can help with investment, and in fact how it's the dominant strategy for 99% of people, and why markets going down can be a good thing if you're investing for the long term, and how a life strategy investment works. At the end, then, I'd get them to endorse a particular fund, perhaps with their name on it, or a suite of funds with their names on it, with varying degrees of risk, blending stocks and bonds, and then ensuring ISA providers were offering those funds. Anything else is pretty much tinkering at the edges. The gap between financial sophistication and effective communication to the masses, and you always have to remember, 50% of people are below average intelligence, simply by definition. Not that this is all about intelligence by any means, but that gap is huge, right, between financial sophistication and effective communication, and it needs to be bridged to make this work. Doesn't feel that hard, doesn't feel that expensive, sounds like it would be highly effective. Videos distributed via social media and traditional media directing potential investors to these funds. What's actually being done instead? A fair amount of stuff that not a lot of people will understand in a fractured way. Long-term asset funds will be included in stocks and shares ISAs, which had previously been for pension fund investments. Advertising to shift low-interest monies to stock investments And I really don't get this bit. If people are using low interest accounts, they're either apathetic, in which case they won't do anything anyway, or they're financially non-savvy, in which case they really shouldn't be investing in stocks and shares. But that's just my 2 pence worth anyway on capital markets for retail investors. Next up, modernising the regulation, which is badly needed in a digital world, let's face it. AI champions and a scale-up unit sounds like more tweaking realistically. There'll also be a concierge service to assist overseas financial firms. You'd think this would only attract smaller players because larger ones would be able to make these decisions themselves, but let's see. There'll also be policy, regulations and messaging aiming to double financial services net export growth by 2035. And the overall reaction has been positive, but compared to more regulations, of course it would be. Some fear another 2008 style manoeuvre, but I think this is lazy critique, to be honest. Anyone who doesn't recognise that very close to a crash, there's likely to be a pendulum swing too far in the direction of too much regulation is not a behavioural economist, that's for sure. This is hardly ninja loans, and LTVs haven't even been touched. Repossessions are a fraction of what they were, with fewer homes back in the late 2000s. I'm more aligned with the City insiders who describe the reforms as underwhelming. And you can see above where I think they've missed the mark or missed an opportunity in a big way if they really want to transform retail investing. There is one area, however, where a tinker might be more appropriate. The largest changes have been made in the housing market overall in this government. And I remain sceptical as to the motives here because they know one of the best ways for an incumbent government to stay in power is for the housing market to be doing well in terms of price rises. The particular dynamic that's playing out at the moment, with lower price properties doing the best, thanks to interest rate normalisation rather than anything else, is more likely to favour their core home-owning voters as well. Just saying. The pension mega funds is the other part I will just dive a little deeper on, primarily because they have the ability to get more deeply involved in the UK property market. First of all, how do you define a mega fund? Well, it's a pool of capital holding more than £25 billion. If you followed Australia or Canada when they went mega fund, which actually was in the last millennium for the record, real estate investment was limited before that. It was usually indirect and often via REITs or pooled vehicles. And then after, pension funds could afford in-house teams, make global investments, and allocated between 8 and 15% of assets into property in Canada. In Australia, it went from almost no real estate investment in pension portfolios to 10 to 20%. Australian pensions also own parts of Heathrow, King's Cross, and offices in New York and Tokyo. And Aware Super, big Australian fund, have got stuck into build to rent and also affordable housing. And the Netherlands are similar, allocating between 8 and 12% after reforms, mostly because they went international, because they always had a tradition of domestic property investment in pensions. If we pick 10% as a number that's come across in all of those countries, we would be talking about 10% of 3.8 trillion in total, which would be £380 billion. The local government pension scheme alone holds about 400 billion, so that would be 40 billion alone. Remember, the residential market is worth around 8 trillion, but 2/3 of that is privately owned or not for rental. So the addressable market is more like 2.7 trillion. You can see the numbers involved are enough to make a significant difference. And if they do start to get heavily involved in secondary market stock, enough to influence prices to the upside, but not so much as to make a huge spike likely in any way. Still, a little more oxygen to the coming fire to the upside that I've been starting to talk about over the past few weeks. So what are they already doing in terms of pension funds anyway? USS purchased about 3,000 shared ownership homes from Blackstone in a £405 million deal last year. Nest, the big government scheme, is partnering on housing joint ventures as well. But some of the commentators have speculated that more like 100 billion might be deployed by 2030 with these changes. The number at the moment, owned by institutions including pensions, between 0.3 and 0.4% of the overall market, or between 1.5 and 2.5% of all rental stock, according to Savills. That's not just pension funds there, though. That would include REITs and funds as well. The commentators' consensus is that 2030 will just be starting to hit their stride, with 10% of the PRS being owned by institutional capital by about 2032 to 2033, in the most bullish case. So we've got an interesting 7 or 8 years ahead while they take their bite out of the cherry. This is all part of the story I'm feeling like I'm seeing unfold in real time at the moment. the nascence really of pension funds and the likes getting involved in UK property. This offers a different level of opportunity to package larger portfolios and prepare them for sale for pension funds, finding out what they do and don't want, what they will and won't accept. There's a few years to get the ducks in a row, but this is truly the future of a chunk of the PRS, whether anybody likes it or not. These reforms are all heading in the same direction, in my view, and on the way there, housing is going to go up in price in the UK and be back to above inflation and above earnings increases percentages. The larger players in build to rent still only have a little over 10,000 units each in their pipelines, plus completions already made. So very large deployments of capital are not easy, but taking a significant share in, say, Granger would only work for one or two funds before they start to influence the price of that stock upwards too much. The secondary market will, mark my words, be the only sector in which these funds can deploy sufficient capital. And those who open the doors and facilitate those transactions will be the ones making the big money. I hope you find that zoomed out perspective useful and also motivational if you're building a portfolio with the goal of exiting at some point. And we all do exit, one way or another. Before I do close, one more reminder to book your super early bird tickets to our next property business workshop that Rod and I will be running on Wednesday, the 1st of October in central London. And this time around, investment metrics and how to run your property business at scale. My favourite topic of all. Book at bit.ly/PBWEIGHT. There's also a link down in the show notes. Above all, though, remember to keep calm, always listen to the supplement, of course, and carry on. There will be opportunities abound this year and towards 2030 and beyond. This landscape has been set for a bull run. It will be slow and things will take a little while to get longer to get off the ground. And the amount of stock around is keeping prices suppressed at the moment anyway. But as yields continue to improve, it's a case of here we go, in my opinion. Thanks for watching, folks.